And on today's show, how deferred compensation plan designs work. Part 3 of this week's series on deferred compensation with Regional Vice President of Business Owner and Executive Solutions, Sherry Flint. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Ismark. Let's get down to business. Well, welcome to day 3, Sherry.
Thank you, Steve.
Well, I'm just in your world of all that is deferred comp, and we're talking about plan designs. Now, you kind of mentioned this at the last segment. We were kind of talking about all the options. There are way more options. I'm sorry, but I guess I forgot about how broad brush this is. I just think of, hey, deferred comp, done. Under 409A, I'm finished. There's only one brand. But there are several ways to play on this. Why don't you walk me through some of the plan designs, because these are good options that we can bring as solutions to business owners.
Absolutely. There's actually 8 components in developing a deferred compensation plan. And traditional CERT plans are still alive and well. I see them a lot in the smaller, closely held business marketplace. When we're talking to larger employees where they're trying to develop a plan that is a supplement to the 401k plan, there's actually 8 components that go into plan design. Every plan is customized based on the client. So we look at eligibility. Who do you want in your plan? Is it just the C-suite? Is it your director level and above? Is it your sales team? Who is it?
So this is can be all discriminatory.
It's all discriminatory. And do we have independent contractors? Do we have a paid board of directors that we want to allow?
I know you mentioned that yesterday, and that surprised me. People are not even my employees.
Independent contractors.
Wow. Okay.
Yep.
Okay.
How do you want to credit earnings? Most plan designs look and feel like 401k, so the advisor will give them an investment menu to select from. Vesting on employer contributions, you have the ability to create any type of vesting schedule you want. So it could be in the form of a match to mirror the 401k plan. It could be an incentive or retention type of a golden handcuff. So vesting is very important. And benefit payment events. Oftentimes we see death, disability, change of control built in. But we mentioned earlier that a lot of plans also include in-service distributions, the ability to take money while you're still working. So that could be for college education, or to buy a vacation home. And those are very, very important plan designs.
Are those just options in the plan that say, hey, listen, if something came up like college education tuition, or I want to put a down payment on my retirement home, or whatever?
Under 409A, you have to schedule those in advance.
Oh,
so
how
each
far
year,
in advance?
Well, each year when you enroll, you can say how much you want to defer and when you want your money back. The rule is the money cannot come back to you within 2 years. So you have to make deferral elections before receiving or earning the money.
So if this year I make the election, I can't take constructive receipt for 24 months.
Correct, from the date you make the election.
And every year I can say, oh, I think I'm going to need that, and I can still make that maneuver.
Every year usually in December, we have an open enrollment period, and we say, how much do you want to defer, and where do you want to allocate it? Do you want to allocate it towards retirement, towards college education, or perhaps both? And so very, very flexible. We also have in there a hardship provision typically, as well as a separation of service. So not technically retirement, but when you leave, that's when you're going to take your compensation. I missed compensation. What type of compensation do you want to include? Do you want to have W-2 income? Is it 1099? Is it bonus? Is it commissions? What categories? Because what you can allow participants to do is defer different percentages of each. So for example, I might say I'm going to defer 10% of my base every year, but 50% of any bonus that I receive. So bonus compensation is a big part of
it. It would
deferred.
seem like you'd do a little bit of tax planning first, kind of get an idea where that number is, and then. But I do like your ability to have flexibility on what goes where. I'm talking about my bonus. I'm talking about my normal W-2 comp. I'm talking about, I got 1099 on the side for something else.
You know what? Tax planning, that is a very good point. Deferred compensation is actually turned into a tax planning tool, because each person can decide how much to defer and when they want it back.
Well, I just thought, I'm just musing over the idea. A lot of our advisors do bracket bumping. I do it, and I'm thinking, hey, I'm sitting there I just creeped over the top bracket. I wonder if I can knock that down, save a nickel today, and if I really have some cash flow, maybe I'm out of debt, I have a lot better move, I have a lot more cash, I might be able to get that down a whole nother bracket. So there's bracket reduction tactics here. And I think, yes, in the old days, I didn't hear this very much. But now, today, tax planning, I think is a big deal.
And that's important. And what's nice about this is each participant, they decide each year how much they want to defer, so they can act, and it comes off the top of compensation. So if you make $500,000 and you defer $250,000, you're down to $250,000 in eligible compensation. The other thing that you can do as a participant, you can say, you know what, I'm going to defer 50% of any bonus I receive, so it doesn't have to be a stated dollar amount. So that way, if you get a small bonus, you might not want to defer 100%, right? So that's another way that we can do that. We talked about employer contributions before, benefit payment options. So you can actually allow participants to take lump sum distributions or installments over a period of time. And think of it this way. If you have an employee that's been with you for a long time and they've amassed quite a bit in their deferred compensation plan, we don't want them to pay taxes on it all in 1 year. So we might allow that person to take it over a 5 or 7 or 10 year period. Maybe somebody with a smaller plan balance or somebody that hasn't been with you as long, we might force them to take a lump sum distribution because the employer is going to want to get a deduction at some point.
Well, not only is he wanting a deduction, but I'm just thinking, if I'm thinking mechanically in my head, when is this money coming out? I have Social Security coming out, I have defined contribution or defined benefit plans coming out. All this affects Social Security taxation. I may have RMD issues. I have to really, this sounds like I have to really be coordinated.
You know, you need to meet with your advisor,
Right.
because what you want to do is you want to integrate it with your 401k plan and any other type of money, right? This is not subject to minimum distribution requirements, so it's a great complement to a 401k plan.
So you got a little flexibility there because I could really forestall this.
Absolutely.
We come back from the break. I want to talk about the financial options. There sounds like there's a couple methodologies to make this happen. I just thought we were just paying out of cash flow. We come back, Sherry's going to tell us, not only au contraire, but she's going to show us a couple of financial methods that I think are really unique.
Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company.
Well, welcome back to the segment. Sherry, you're saying that there's many options here on the methodologies to finance this. Walk me through this, because I guess I was a traditionalist. I just thought it's coming out of cash flow and that's it.
You know that, and with larger corporations, oftentimes it does. So what we do is we sit with the employer and we decide, you know, there's 3 different ways you can set up your plan. You can have an unfinanced plan where you actually pay out future liabilities from cash flow. And I would say 1 out of 10 companies will do that. It's going to be typically your very large institutional clients that if they had to pay out $500,000 tomorrow, they just write it out of cash flow. Most of the companies that we work in that middle-sized market, they're going to finance their plan, and they're going to have 2 choices. They can have corporate-owned mutual funds or what we call taxable investments. And in that case, we're going to give the participants a menu of investment choices, and then the company's actually going to go out and buy them. The challenge with corporate-owned mutual funds is every time the participant moves from Fund A to Fund B, the corporation's going to actually buy and sell those mutual funds to mirror what the participant's doing. Now what happens? The company actually pays taxes on the gain. And every time the fund manager buys and sells shares with inside the portfolio to keep with the fund objective, it triggers a tax.
Even in a loser year.
Even in a loser
my
year.
Goodness, yeah.
Absolutely.
Yeah.
So for corporations, oftentimes that creates more tax. It's a cash flow expense. The third option that we see is corporate-owned life insurance, and that is basically a variable life product. And what we do is we set it up where the participants have the investment choices the participants have are from the menu of separate accounts. What's nice about the insurance is it acts as key person insurance on 1 or more of the participants and or the owners of the company. And insurance grows tax deferred and you borrow against it tax free. So oftentimes insurance can be a very cost effective solution for companies. I would say about 6 out of 10 companies will use corporate owned life insurance.
Well, it's interesting because I think the market is understanding the tax ability, the real tax advantages of life insurance, and this is just one option for that. When we're talking about, and I want to go to your next slide here, when we're talking about the taxable securities, corporate-owned COLI, I didn't put, and I'm so sorry to say, maybe this is my ignorance, but I did not put the word COLI in the same sentence with deferred comp. So walk me through that, because that was kind of a new idea to me.
Okay, so essentially, corporate-owned life insurance, basically what we're doing is we're establishing a sinking fund, a corporate asset for the company to pay off those future liabilities. So it has nothing to do with the participant accounts. Of course, we want it to mirror what the participants are doing, because if we owe $500,000, we want to have $500,000. So corporate-owned life insurance is basically a variable life contract owned by the corporation. They're the owner, they're the beneficiary, and they could do an endorsement split dollar to the insured as well. But here's what's happened. The decision comes down to this. There's two types of expenses. You either pay taxes on mutual funds or you pay corporate premium expenses and cost of insurance on insurance, right? So there's 2 expenses. Which one's cheaper? Typically what we'll do with a company is we'll go through a financing discussion. We'll go through what are the cash flow costs, what are the tax ramifications, what is the impact to your corporate equity using corporate-owned mutual funds versus corporate-owned life insurance. What typically happens is if a company's in a 15% or higher tax bracket, the taxes are going to be more expensive than the cost of insurance, and they're going to like the insurance better.
Okay, so they're just going to take the total expenses of whatever the fund they're into. That'll include the fund's cost, its statement of additional information, the IRA fund, maybe wherever there's a charge there. And then they got to figure out on top of that, there could be capital gain treatment here because we're mirroring it. versus here are the expense loads aside, cost of insurance, premium load, whatever it is, and here's the tax wrapper around it.
Absolutely.
So I have to just look at the arbitrage betwing the two and figure out which is the better deal.
And here's the challenge.
But I was surprised. I'm so sorry to interrupt, but you said 15%. That I would have thought you needed to be higher to make that work.
Nope, generally
that
speaking,
surprises me.
15%. And, and some people have an affinity towards insurance, right? They liked having the key person insurance. They like having that tax-free death benefit. So oftentimes insurance can work very well. But here's the challenge, the additional challenge with taxable securities is C corporations, there's no capital gains. It's all ordinary income tax. And with S corporations, there's a little bit of capital gains, but not much. So oftentimes mutual funds can be a very, very expensive way to design a plan.
Well, I think these options are great, and again, I'm kind of rocked a little bit by that's a low bracket. I just saw a whole nother section of businesses that we could approach.
Absolutely.
Because I'm thinking, well, to make this work, I need to be up there in the 34 number, and you said 50. If I'm coming in at the entry of 15% tax bracket, I think, wow, that just brought in a whole middle ground. I'm tons of personal small businesses, which are the backbone of America. So I see this is a huge play. I did not realize the math was that attractive at that lower tax bracket.
It is, and you know what? When you show them the math, they'll say, "Oh, I get it." Right? The financing folks that are making the decision are not, they get it.
Sure. Well, that's all the time we have for today's show. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our site at downtobusiness.ashbrokerage.com. Want to email me? steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.